Welcome to this episode number 64 called today UtilitAIes. So we had another strong week for stocks with a risk on all over the week as we're going to see later. I would like to start with a rest in peace to Jim Simons, which was the greatest quant portfolio manager of all time. As you can see, there is a good book in the background that explained a bit of insane life as a quant. So many people over the last 25 years have been trying to replicate without much success what Renaissance and Jim Simons has been doing for over 30 years with 40% plus performances. So really, this has been the rise of the machine, the algo. So for people like me who have been more, into the discretionary space and trying to find some models, I've been, really looking at those people like trying to there have been like great emulation. So a quick rest in peace. So let's go back to the market and starting with one of the sectors that has been outperforming the market over the last 15 sessions. So if you look at the chart here, as you can see, XLU, the utility sector has been very strong. So you see this chart, really going. So as if, passive investment, algos, quants have been putting over the last 3 weeks a strong bid, a VWAP order. So there are many explanations, and it's easy to do some back trading. So back trading is always easy, but there are obviously some explanations. One of them is artificial intelligence. We do know that the servers will be asking for a lot of electricity, and that will be putting a lot of pressure on the grids, not only in the US, but all over the world. And we saw, you probably saw the news this week that in India, due to the heat, will be having the most pressure on its grid in the last 50 years. So going forward, XLU, as a second derivative of artificial intelligence, one of the reasons as well, we are in an election year, so we're going to have the themes that we had in 2020, which is infrastructure. And obviously for infrastructure, you need a lot of electricity going forward. And as we're going to see, XLU has been a big outperformer over the last 3 weeks. So what about the year-to-date asset performance? Now S&P is back to close to the 10%, so almost double-digit for the year. You see all the stocks have been doing pretty well, except the Bovespa, but overall, strong risk on a year-to-date basis. For the US dollar, pretty strong so far. Crypto still doing the same, very strong. And what we see as well, and that's something that we flagged 6 weeks ago, commodities, real assets. We are talking copper, we are talking gold, really outperforming the market now. We had a strong move in copper. One of the reasons that we explain is China reduced its supply. That means, if you think a bit of supply and demand for commodities, if you reduce the supply, by definition, the prices should go up. You have big investors that are putting money into that space, and obviously electrical vehicles means that in the next 5 to 10 years there will be a huge demand for copper. So big move in that space. Now going in the week to date, so stocks doing very well. We are talking 3% in Europe, which actually is outperforming the US, 2% for the S&P, kind of flattish for the euro dollar. Crypto, a bit of pressure yesterday on Friday. And finally, as I said, those two 2.6%, as if, and something that I mentioned 2 or 3 weeks ago, as if, real assets, you putting a bid and you buying a basket of real assets. So year to date, I don't want to be spending too much time, so let's jump immediately on the week to date industry performance. And this one is interesting because you got the gold miners, the silver, the utilities. Normally in an up market, you will not see, gold miners and silver doing so well. So it's back to the question, when VIX, when volatility is matched due to many products, when you can't be hiding or protecting yourself by buying bonds, one of the ways is to be buying gold, to be buying gold miners, and to be buying silver. And that tells you that despite volatility, implied volatility, realized volatility pretty low, underneath there are some questioning by the market and by market participants, and more importantly, how can you hedge your portfolio when the volatility is not really working, and as well when your bonds are not working. So sectors performance, this is the one that I'm interested, and you see utilities, big outperformer, 4.2%. You had names, so I strongly advise you to go deep inside the XLU and look at the names that have been outperforming. You had some charts that literally look like AI, like the charts that we had like 3-4 months ago with the semiconductor. So really strong market. Consumer discretionary will be always struggling if Tesla is struggling on the week. And other than that, we had only green for the week. So very strong week since we started 3 weeks ago, since the start of May. 4.5% on the US 10 years. We are all waiting for now the CPI and the PPI on Tuesday and Wednesday. So 4.5%. We went from 4.2%. We did the breakout, even if I don't do technical analysis, on to 4.75, 4.80. So we are in this mid-range since the breakout and waiting for the next news. Still a good inversion at minus 0.36% on the 10 versus the 2. Finally, for the rates, I would like to talk about the Fed fund rates and what has been the move that we saw since the start of May. So if you look at the end of April, the expectations were for the Fed at 5.10% in December versus 5.33. So what that was telling you that the market was expecting a bit less than one cut rates by 25 bips at the end of this year, and now we are a bit high, a bit lower, or a bit higher, depending on how you want to express it. So we are expecting a bit more than one cut. So market has been pricing a more dovish Fed, not only because of inflation. Many numbers, many data through the ISM, through yesterday the University of Michigan were telling you that inflation is still very high. But the Fed has a dual mandate, and the mandate is as well about unemployment. And actually, if you look at unemployment through the ISM, through the weekly numbers, and through the NFP data that we had last Friday, there are some indications that the US labor market is deteriorating. I mean, not like crazy coming down, but instead of having 200,000, we're going to have 150. So it's coming down, and Powell has been pretty clear over the last few talks that he's putting more weight on the employment market. In other words, is okay to be running an economy pretty hot in terms of inflation, or higher than usual. But if he's seeing more bad data for the job market, then he will be cutting. So you can make sure that if the June number are going to be bad for unemployment, that there is a good chance that they will be cutting rates by 25 bits in June. What about volatility? Finally, so VIX, below 13%. So we are back to the very low level. There is nothing like the low level in volatility. Trust me, it could go much lower. But that tells you that very quickly we have been smashing volatility due to better EPS and I say results from companies, from, as I said again, many products that have been selling the volatility. So let's jump now into the technical analysis with starting with the S&P. So S&P, we are still in this range and going higher. We have not been making new highs. So new highs are not that far from here. We are talking, 2% from here. From the Nasdaq, it's a bit of the same color. We are very close to the recent highs. The Russell is not moving. So despite all those calls of those specialists telling you, the Russell 2000 is going to be doing very well, it's not the case. And that tells you that the core US companies, because Russell 2000 is more about, companies that have exposure to the US are not doing as well as the big companies which have exposure to the rest of the world. Meta, Facebook versus the S&P, same. We have been consolidating for since the start of March now. No real, let's say, catalyst going forward. Having said that, we have some news coming with Apple with artificial intelligence, so that will be a space to watch. They could be announcing very quickly that they will go into artificial intelligence, and that could be, one of the movers going forward. Oil struggling to go much higher. The supply is still pretty big coming from the US. So as long as they are flooding the market with oil, it's going to be hard to go much higher. Copper, so we flagged that one when at the start of the move. I'm not saying that I told you to go long. I'm not going to pretend. But clearly, China has been cutting supply. As I said, there are many drivers going forward that we all know, and so we saw a big move. And I think what is interesting is if you look at the performance of copper versus the gold, it's the same on a year to date. So again, if you want to be buying and protecting your portfolio these days, you need to be buying real assets, and everyone is jumping for the same names, which are copper, which will be gold. Euro dollar, same. Dollar yen, so we had the intervention. So since we last discussed a couple of weeks ago, we had two big interventions from the Bank of Japan. So we retested the 152 level, and now the market is waiting for same here as the next catalyst with the carry trade, which is not in favor of the Japanese yen. Finally, looking at Europe, so Europe, very, very strong here. You're looking at the stock 600, which is the equivalent with a much smaller size of the S&P 500, and we see the breakout. We are going higher. I'm interested into the DAX because the DAX is telling me that we are at the top of this trading range. Again, that is a bit of dodgy technical analysis as always. You need to be careful, but DAX to me seems a bit toppish. So let's go back now into the Excel spreadsheet, looking at what happened for the week. So this is for the S&P as always here, looking at the S&P futures over the last 5 sessions. You go up, you consolidate a bit, you go up, you consolidate. So pretty much like you sell volatility, you go from 14-15% on the VIX to 14 to 13, then you consolidate, you go another way up, and it doesn't really matter what are the macro numbers, what are the anything, it just go up. Okay, so that has been for the week, with actually something very interesting. The volume on the S&P were very, very low. So on one hand, you can argue that Europe was pretty much half working this week, but if you look at the SPY volume for the week, we are many days trading around 40-45 million shares, which is kind of the volume you will see around Christmas or Thanksgiving. So very, very low volume. That doesn't mean that the market should go down. That means the participation in low, but for the time being, the market is squeezing, and you deal with the market that you have. So as always, price action. What about fundamentals and how the market has been behaving in terms of the S&P 500? So that will be here, where we look at all the S&P 500 companies that have released their numbers so far in terms of sales and the earnings. So sales, you can see they have been doing pretty much what they have been doing most recently, and for the earnings a bit better. So in other words, sales bit for those companies have been doing just a bit better, and EPS beating by 8% plus. So what is happening is companies are not selling that much or more than usual, but their margins are still very, very high. So I've been trying to flag the top over the last couple of years about those top margins. They managed to keep those margins very, very high. So that explained the EPS bit. And that explained as well that, as always, before the start of the earnings season, the numbers have been coming down quite a lot. And that makes the bit more easy. But in other words, this earnings season has been pretty good, okay, versus history. And part of the moves that we had over the last 2 to 3 weeks by 4 to 5% is due to that. Now, I want to talk about fundamentals and macro through the city economic surprises. So that's more about the macro, and to tell you, what has been the recent trend. We are talking both global, US, China, and Europe. And you can see more recently, we have been trading lower. In other words, the macro expectations have been coming down. Not the expectations, but the surprises have been coming down. So it's not as like, the economies are doing that well. And that's confirmed with the ISM manufacturing and services. We had one data yesterday from the University of Michigan, which is about confidence. The numbers were really, really bad, and telling you, it was stagflation, looking at both the index, both at the expectations and higher inflation. I think there has been a bit of a struggle over the last 3-4 years with the correlation between the University of Michigan and the overall market and macro conditions. So I don't think this is as good as before, but what you can argue is, if 70% of the economy is done with US consumer, you get some signs that the US consumer is not doing as good as, most people will, or not most people, but like how the market is pricing it. And on the other hand, you can argue that, those data are not as relevant as they used to be. Okay, so that has been for the week. Going forward, this is mostly about inflation. So we get the PPI on Tuesday, we get the CPI on Wednesday. So far, we had a bit of volatility recently when the CPI was released. We were moving by 1%. Actually, the S&P weekly straddle. So what is the S&P weekly straddle? That is, by how much market participants are expecting the S&P to be moving from now until next Friday. And its market are pricing plus minus 1.2%, which is very, very small. If you look at this week, we moved by 2% on the S&P. So straddle is very little, which goes hand in hand with the VIX at 13% and below. So right now, if you believe that you could see some moves going forward, that you could see volatility back, actually many volatility products, or being long volatility, has not been as cheap as that, like I think since 2016. So very, very cheap. So you have really a divergence between, if you look at the price action, some assets that are telling you that underneath there something is bubbling, that market participants are struggling to keep an healthy portfolio, and in the meantime you have volatility that is very, very low. As well, you have Wednesday retail sales, you get Fed speakers with Powell on Tuesday. So really PPI, CPI. For the CPI, we expect, plus 0.3% month on month and plus 3.6% year on year. Retail sales are going to be interesting and important to understand how the US consumer is doing. You have some other names for the US consumer. So you get Home Depot earnings on Tuesday, and you got Walmart on Thursday. So those are two market drivers. And as well, I strongly advise you, I like to be listening to Home Depot conference call, because they tell you a bit, what is the average basket of a US consumer. Finally, for the biggest catalyst of them all, this is the correlation between, on the left-hand side, this is the S&P. So the S&P, this is the blue line, and then you're going to have the white line, which is the 10 years futures. As you can see, we had a strong correlation. When yields are coming down, stocks are going up, and that has been the case for the last 2 to 3 months. So really about inflation, how the bond market is going to be doing, and that's going to tell us, how stocks will be going forward. So this is it for me today. If you like what you saw, what you watch, please put a comment, put a like, forward the content. That helps as always. If you want to join the community, please feel free to do so. There is a Discord community where we're going to have a big channel. I'm trying to put as much content as possible. This week I went through some people that were not happy about something, and I had to explain that we don't want to create a FOMO channel. So this is about, explaining the fact and not coming back every 2 minutes saying, I told you so, I told you so. So really, this is the kind of product that I want to build with you. If you have questions on the 4x4 video series and the mentoring, you can reach me at Greg@Dupont Trading. This is it for me for the week. Have a good trading week. I'll see you next week. Bye-bye.